Alright, hey guys, Scott here again with a brand new video, and for this one, I'll be walking you guys through my personal daily option trading routine. Pretty much everything that I do from the pre-market hours all the way to the market close every single day, right? So hopefully this video here will give you some good insight and some good ideas into what you might want to do as part of your own process as well. Right? Because bottom line, in my opinion, having a very concrete and well-defined trading process or routine that you stick to every single day is very, very important. And that's because having that routine helps keep you very calm and rational during each trading day, and ultimately helps to eliminate any kind of emotion or unnecessary subjectivity in your trading. And I can definitely say from experience, especially in my earlier days of trading where I did not have this kind of routine very well laid out, that whenever I did get emotional or I made trades based on just feeling or just whims of the moment, etc., that pretty much always led to disaster. So again here, having a very concrete routine or game plan every day is very, very important for your success in the long term. Now briefly here before we dive in though, if you guys want to receive up to 13 free stocks where each stock could be worth up to $2,000, then make sure you watch until the end of the video. And also, if you want to join a very exclusive online community where you can learn how to trade options and my overall custom approach to the markets, then you can now join my options trading Discord as well. So definitely check out the video description below to learn a lot more about that. And then lastly here, for anybody who is also brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the video description as well. So be sure to check them out, and when you join SKILLSHARE using those links, you'll get a full 1 month free trial. Alright guys, so now diving in here, and so for this video, I'm basically going to break things up into 3 main segments. So I'll show you everything I do during the pre-market hours, and then my routine during the actual regular trading session, and then lastly, everything I do once the market closes as well. So beginning here first with my pre-market routine, right? So basically about 1 hour or so before the general market opens at 9:30 a.m. Eastern time, I'll come onto my platform here, which is thinkorswim, and I'll check out the futures markets. Right, so for example, there's basically 3 different futures contracts I care about the most, which is number 1 here, /ES, which as you can see here are the E-mini S&P 500 index futures. And so the main reason why checking futures markets is so important both in the pre-market hours and also at nights as well is because, as I kind of just mentioned there, these futures contracts do trade 23 hours a day, 5 days a week. Right, so essentially when the regular stock or option markets are closed, the futures markets are still typically going to be open and trading unless it's the weekend basically. So again, watching the futures markets during non-regular trading hours still gives you some great insight into what's happening with equity markets pretty much 24/7. And so ultimately, based on what's happening pre-market with the futures, that's going to have a very large impact on the regular market open. Right, so for example here, if right now was pre-market trading and the futures here were either up or down by some significant amount, then chances are my individual positions, these stocks that I have positions on basically, are also going to be either up or down by some significant amount as well. Right, because bottom line here, the S&P 500 or basically any broad market index is the tide, so to speak, that raises or lowers all boats. So again, when the S&Ps are up or down by some significant amount, chances are most stocks in the market are going to be either up or down by some sizable amount as well. And then based on the positions you have on those particular stocks, that could either be a good thing or a bad thing for you. And so then lastly here, along with the S&P 500 futures, I will also check out the /NQ contracts, which is the futures contracts for the NASDAQ index, which nowadays is mostly tech stocks. So of course, specifically for any tech positions I may have on right now, perhaps in things like Apple or AMD, Nvidia, etc., then I will definitely pay close attention to the NASDAQ futures for those kinds of positions. And then lastly here, I will also take a look at /RTY, which is the futures contracts on the Russell 2000 index, which is mostly small to mid cap kind of companies. And so now at this point, once I have taken a look at the futures market here, and I basically have some kind of assessment as to what the market open is going to be like, I will then look at my individual positions and basically plan what I may have to do at the market open at 9:30. Right, so now we'll come over to the monitor tab and take a look at my current positions here. And so as you can see, I do have my trades broken up based on their different position types. So for example, I've got 2 naked puts on, short naked puts that is, and also 4 short strangles. Although that being said, each position here could be very different within its own categories. So for example, AMD here, I basically just have 2 short put option contracts with a 75 strike. But for Nvidia here, because the stock right now is below my 145 strike put option, right? So as you can see, I'm short 1 contract here. And so also I am short 100 shares of the stock as well, right? So basically for my particular approach to options trading, my strategy is all about selling naked options, naked calls, puts, strangles, things like that. But I will either buy or short the stock if the stock itself does breach one of my strikes. And so as you can see here with the case of short put options, if the stock drops below my strike, then I will short sell 100 shares of stock per contract. Now that being said, diving into all the specifics of that exact strategy is definitely out of scope for this video, but bottom line, having my positions here all laid out and categorized helps me assess what's going to be happening to each one of them, again, based on what I'm seeing in the futures contracts. Right, so for example, if I see the NASDAQ futures are up significantly pre-market, then I know there's a very good chance that my AMD trade is going to be doing well, or that AMD also is going to be up on the day, at least at the market open. Right, so therefore I can expect that my 2 short put options here in AMD should be, making some money once the market does open. Although for my Nvidia trade here, because I'm short 100 shares of stock and this part of the position is actually making the entire trade have an overall net bearish bias to it, then that means if Nvidia is also going to rally as well, then I'm most likely going to lose money on this position. Now, of course, also pre-market, I will check what each individual stock is doing pre-market as well. But again here, just by checking the futures contracts on that one assessment alone, I've got a very good idea as to what my entire portfolio is going to be doing once the market does open. And then based on looking at all of that, right, both the futures and also the individual stocks pre-market, I can come up with a game plan of what I may need to do for each position once the market does open at 9:30. Right, so again here in the case of AMD, if the NASDAQ futures are up and AMD is also up as well pre-market, then pretty much nothing I've got to do for that trade, right? Because like I said, that trade should be making money. But for the case of Nvidia, because that's a more complex position with both short puts and short stock, then I may have to keep a very close eye on that position if Nvidia does rally too much during the day or at the market open. Right, because as I explained, if the stock falls below my put strike, I will short the stock. But if the stock rebounds back above my strike, I'll have to buy back those shares, close out that stock position, and move on. So again, bottom line here, based on my morning assessment of what's happening pre-market, I now have a mental note of what I may have to do with my Nvidia trade should the stock increase in price back up to my put strike. And so then once my pre-market routine is done, I basically just wait for the regular market to open at 9:30. And then at that point, I'll make whatever adjustments or manage my trades how I'm supposed to based on what I saw in the pre-market trading hours. And so then once I have my current positions taken care of for the time being, then it becomes time to look for new trades if possible. And to do that, the first thing I'll look at is if we come over to the charts real quick and we go to /VX now. And so these are also futures contracts, but for the VIX index. And so the VIX index, in case you're not aware, is basically just an index like the S&P 500, for example, but it specifically measures the implied volatility on the S&P 500. And bottom line, implied volatility is very, very important for options traders in general, right? Besides the actual stock price, the implied volatility of the stock has the next biggest impact on the options price. And specifically, implied volatility in general is just a measurement of uncertainty basically about the future. In this case with the VIX, it's about the S&P 500's future, but you can look up the implied volatility for individual stocks as well. And most importantly, as implied volatility increases, or basically as there's more and more fear and uncertainty in the market, then option prices will increase as well. And then conversely, as implied volatility goes back down, option prices go back down as well. So ultimately here, analyzing the implied volatility for the S&P 500 gives you some very good insight into where, generally speaking, option prices are right now across the market, right? So for example, in these moments where the VIX has spiked dramatically, then again, across the board, you're going to see option prices increase substantially as well for pretty much all stocks. And so then depending on whether you're an option buyer or an option seller, the VIX here is going to help dictate on when is going to be an optimal time to place positions. So for example, in my case, as an option seller, I want to wait ideally for times like this where the VIX has spiked, right? Because again, during these times, I'm going to be able to sell options for very, very high prices. And that's going to make for the biggest potential profits for me. And then conversely, when the VIX is very, very low, especially during this time very recently, then I will definitely scale back my risk, or I'll make fewer and fewer trades. So bottom line, based on the current level of the VIX and also based on how much capital right now I do have allocated across my existing trades, I'm going to use both of those things to help me figure out if I do want to place more new trades today or if I'm just going to sit back and wait for a better opportunity. But then also alongside analyzing the VIX here, I will also do some basic technical analysis on some of the major broad market ETFs or indexes to basically gain an overall directional assumption or bias for that day, right? So for example, let's take a look at SPY real quick. This is an ETF that tracks the S&P 500, and I'll go ahead and zoom in here a little bit. So again, as you can see here with all these lines and a few moving averages, this is pretty much my preferred way of doing technical analysis on equities in general. So right now, for example, as you can see here, there's pretty much a battle going on between the bulls and the bears, where on the downside here, right around $390 per share, the bulls have been trying repeatedly to buy the market back up, right? So basically for the time being, around 390 is a pretty major support level. And then at around $400 per share, the bears have been successful in selling the market back down lower. So that makes this price level at around 400 a major resistance point. And so bottom line here, typically the way I trade, I like to be basically a contrarian based trader, which means I typically go against the grain or against the herd. So when I see stocks going down and reaching support levels, oftentimes I will make bullish trades, right? To basically play for a short-term bounce. And then if I see stocks rally into a resistance level, at that point, I will look to place bearish trades to play for a reversion back down lower. And so right now, based on where SPY closed during the last trading day, basically very close to the support level, then that means the next day, my first assumption is I'll be keeping an eye out for possible bullish trade setups. But that being said, before I do go ahead and start looking for new possible bullish trades, I must take into account my general portfolio bias with my existing trades, right? So if my portfolio as a whole is already leaning very bullish right now, then I don't need to add more bullish trades, because if I'm wrong, or if the support level does finally break and the market does go lower, I'm going to get screwed. So ultimately, I don't want to be overextended in one direction or the other, right? I don't mind my portfolio leaning bullish or bearish in certain situations, but again, I don't want to be too bullish or too bearish, because if I'm wrong, I'm going to have to defend a lot of trades and possibly lose a lot of money. So then based on that, we'll come back to the monitor tab real quick here, and then I'll take a quick look at my portfolio deltas here, which are currently beta weighted against SPY. Right, so basically these beta weighted deltas just tell me approximately how much money I'm either going to make or lose based on how SPY moves. Right, so specifically the way you read this is if SPY goes up by $1, then for AMD, for example, I expect to make about $23 on that position. Right, because again here, the broader market or the S&P 500 is basically the tide that raises or lowers all boats. So if SPY increases, chances are AMD is going to go up along with it. And therefore, for my two short put options here, these are going to profit by some amount of money, which based on the relationship between AMD and SPY, that amount of profit is expected to be about $23. And then for NVIDIA here, because as I explained, with this being a more complex position with 100 shares of short stock, the overall bias of this trade is now bearish. And that's why my deltas on this position are negative. So again, if SPY goes up by $1, I would expect to lose about $22 on my overall NVIDIA trade. And then vice versa as well. If SPY goes down by $1, I would expect to lose about $23 on AMD, but make about $22 on NVIDIA. And then below that, you can see here the weighted SPY subtotals. So 23 almost plus negative 22 is about 1. And then for my strangles here, you can see for Amazon, my trade is currently leaning bearish with a negative 25 delta, but for FCX, I'm currently still bullish with a positive 10 deltas. And then same thing, the full sum of this entire category is negative 27.51. So finally, the total beta weighted deltas for my entire portfolio is negative 27.5 plus positive 1, which of course would be negative 26.5. So ultimately right now my entire portfolio as a whole is still leaning a bit bearish. So therefore, when I saw on the SPY charts that SPY is basically right on that support level, if I wanted to place a bullish trade, then my portfolio here could definitely accommodate that. But if, for example, my entire portfolio deltas were, let's say, positive 50 or positive 100, then my portfolio is definitely leaning pretty bullish already. So therefore, in that case, I would not need to look for any more bullish positions. But again, for this case, as of right now, I definitely can look for a new bullish trade. So as a result, I'll now come over to the Market Watch tab here and take a look at my watch list. And so again here, being a contrarian based trader, I like to buy stocks or get bullish on stocks when they're down on the day and ideally have reached a support level. And then conversely, I'll get bearish on stocks if they have increased significantly and reached resistance. And so in the case here of looking for a bullish trade, one thing I can do is sort my list based on the percentage change of the day. Right, so now my entire list is sort of based on the percentage price change from the biggest negative change all the way to the biggest positive change. So back to the top here, as we can see that Upstart, as of the last trading day, was down by over 6%. So this here definitely could be a good candidate for a bullish trade, but also I must pay close attention to the implied volatility as well. Now this stock fortunately has very, very high implied volatility at 118%. This is pretty much one of the most volatile stocks I've seen. So therefore, in most cases, this stock here is going to have very, very expensive options. And so then next we'll go to the charts and take a look at the actual Upstart charts. So UPST, and then we'll go ahead and zoom in here a little bit. And so here we can see this stock is pretty much stuck in a sideways consolidation pattern and has been so for quite a few months at this point. So therefore, a possible trade I would probably make on this stock would be a bullish skewed strangle, right? So basically I would sell both an out of the money put option and also an out of the money call option, but I would make sure the delta on the put option is greater than the delta on the call option. And that's what would give this trade a bullish bias. Now, that being said, there are tons of different ways or strategies you can use to get bullish on whatever stock you want to. So the major point here, the bottom line, is just the fact that, again, based on what you see with the broader markets and what your directional assessment is for the market in general, and then also based on what your portfolio needs right now. Is it too bullish? Is it too bearish? What kinds of trades do you need right now? All of that's going to help dictate what kinds of trades you should look for today. Right? Because ultimately having a very well-balanced and diversified portfolio is crucial. So for example, if you are too focused on just the tech sector and you only have bullish trades on tech stocks, that's going to leave you very, very exposed to a possible downside move in the tech sector. But conversely, if you had both bullish and bearish trades on tech stocks and then also bullish and bearish trades on industrial stocks or financial stocks, different sectors and industries, etc., then if something happens to one of those sectors, chances are your entire portfolio is still going to be just fine. And even in that one sector where things do go bad, again, if you are diversified within that category with both bullish and bearish trades, then your losses in that particular sector should also not be that bad either. So again, bottom line, do try to keep a good mix of different kinds of trades with different directional biases on a very diverse group of underlying stocks. And then having a very mechanical process or routine where you, again, analyze the markets, analyze your portfolio deltas to ultimately figure out which kinds of trades you need right now to keep a diversified, balanced portfolio. It makes all this very, very easy to perform on a daily basis. And then finally here, once the market has closed at the end of the day, basically, I will log all the trades I made in that day in my trade tracking spreadsheet. Right, so for example, if I come over here, as you can see, this is my spreadsheet specifically for the month of August 2022. And specifically at the top here, this is where I log all my new positions. And so as you can see, I have things organized by their position category, like these are all my naked call options. These are put debit spreads, short strangles, naked puts here, etc., etc. And then with each trade, there's a ton of metrics and bits of information I track about each one of them. And then ultimately down below all of that, I have some high-level portfolio statistics where I can track my general portfolio performance, both for the current month and for the current year. Now that being said, you definitely don't have to have a tracking spreadsheet as complex as this, but bottom line, in my view, you should have some way of tracking your trades and some important details about each one, right? Because bottom line, the best way to learn and improve your trading is to analyze past trades and past mistakes and to figure out new ways of being better in the future. Now, if you do also want to see how to create something just like this, I do have a Skillshare course on that exact topic. So again, check out below to see a link to that specific course. But ultimately, once I have all my trades for the day logged in my sheet here, and I can kind of sit back and view things from a bird's eye perspective, that also gives me some very important insight into how I might need to manage and plan for my trades come tomorrow, right? So for example, based on what perhaps happened today with my NVIDIA position, I can use all this information here to assess what I may need to do come tomorrow to manage and adjust this trade, right? Because as I said earlier, the goal here is to eliminate all emotion and subjectivity from your trading. So again, being able to track your trades with detailed metrics and using that information to create game plans to know what to do in all possible cases, and ultimately having a broader, well-defined routine and process for your trading every day. That's going to help you stay consistent, calm, and rational, and ultimately successful in the long term. And so with that being said here, that's going to do it for this video. But of course, one last thing, as I mentioned, I've got a very cool opportunity for you guys where you can receive up to 13 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 13 free stocks when you open a brokerage account with them using my specific link in the video description. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the video description below to sign up and get your free stocks. And also don't forget to check out and join my options trading Discord as well as my Skillshare courses. Links also in the video description. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.